Hi, I'm Ben from Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. There has been an argument raging for decades between investors. Which is better to grow your wealth? Stock market investing or property? In this video, I'm going to compare and contrast these two types of investment so you can decide which is best for you.
Let's get ready to rumble!
Before we get started, go ahead, smash that like button and subscribe if you haven't already. Be sure to tick the notification bell, that way you'll get updated when I release future videos like this to help you. Let's get into it. Point number 1, upfront capital. Property requires a massive amount of upfront capital to get started. These days, most people will get a mortgage, and that will require between 10 and 25% deposit on the property. This can be a substantial amount, especially given the average UK house price is $220,000. For lower cost houses up north, expect to need at least 30 to 40k to invest in one of these properties. Whereas with stocks, you can get started from as little as £1 and you can invest little bits over time and dollar cost average your investment. That's 1 point for stock market investing. Number 2, liquidity. Property is not a liquid asset, which means it cannot be bought and sold very fast. So if you need fast money, it can be difficult to pull that capital out of the property fast. The only times you can do this is if you remortgage the property or if you put the property into an auction, but that still takes a lot more time than stock market investing. Investing into the stock market is instant. You can buy and sell shares rapidly and even multiple times a day if you're a day trader. Number 3, the magic of leverage. When purchasing a property, you can use the power of leverage from the bank via a mortgage to purchase an asset which is much more expensive than you can actually afford. This will multiply your return on investment and your earnings. Despite borrowing up to 75% of the property's value, the full returns of the property, including capital appreciation and rental income, is yours to keep. The only type of leverage you can use on the stock market is via risky day trading, which doesn't compare. Number 4, return on investment. This is a tricky one, as your return on investment is highly dependent on which property or stock you purchase, when you buy and when you sell. However, it can be said that the stock market has produced an average return after inflation of 7 to 8%, whereas with property you can get a rental income return of 6 to 10% plus and also a capital appreciation return of 10% plus. This is a total return on investment of 20% or more, which beats stock market index funds. Now you can make even higher profits on the stock market if you invest into individual stocks. However, with great rewards comes great risk. For example, if you invested £1,000 in 2009 into Amazon, today it would be worth nearly £14,000. That's a substantial increase of 1,232%, much better than the bank. However, if you would have chosen the wrong company and invested into a company such as Toys R Us and didn't sell before their big crash, you would have been left with nothing. That is the risk of investing into individual stocks on the stock market. Thus, on balance, I will call this one a draw. 1 point each for stock market investing and property. Number 5, the power of adding value. Property gives you this amazing opportunity to add value to your asset. You can refurb the interior, you can put in a loft conversion, or even a full-on extension. This means 2 properties in the same street can fetch very different amounts, whereas 2 stocks of the same company will be worth the same value, and there's nothing you can change or alter to make it better or worse. It is as it is. That's another point for property. Purchasing a property requires you to pay a large amount of fees. These range from solicitor fees to management fees to estate agent fees and even valuation fees from certain banks. You also must pay stamp duty on any property purchases which are your second home. This can range from 2% to 5% and can really impact the upfront cash you need to start investing, as you can't borrow this from the bank. Property is also less tax efficient in the UK, with the UK government seemingly hell-bent on destroying landlords. They even brought in a new law called Section 24, which requires landlords to pay tax on turnover rather than profit. This defies the rules of business, but has still been brought in as legislation. Whereas stock market investing is very much backed by the government. You can invest using a stocks and shares ISA, and this will protect you from capital gains tax up to £20,000 each tax year. You can also receive a £2,000 dividend allowance tax-free from your stocks. There are also various government-backed schemes, such as the Lifetime ISA, in which the government will give you a 25% bonus on anything that you invest into that ISA. However, the one caveat is you can't touch the money till you're 50. Number 7, security. As the old saying goes, there's nothing safer than bricks and mortar. And while that's true if you have home insurance, property has been proven to survive in almost any conditions. For example, if the stock market is going through a recession or even the economy is going through a recession, you can still be assured that you will receive a reliable rental income from your properties. Properties have also been shown to hold their value a lot more during times of economic uncertainty. Number 8, diversification. Investing into an index fund such as a Vanguard S&P 500 ETF or a Vanguard World ETF, you can diversify your whole portfolio internationally in one investment across multiple industries, from oil to tech and even property with REITs or real estate investment trusts. Property just does not allow you to achieve this type of diversification practically. That's another point for stock market investing. Number 9, short selling stocks. Short selling allows you to actually bet against a stock or index, and thus when the price falls, you will make money. This is a unique point for stock market investing. Number 10, unbelievable cash flow. The incredible rental income you can achieve by renting your property almost passively can allow you to live a truly financially free lifestyle. That's double points for property. Both property and stock market investing are great places to grow your wealth. If you're serious about investing, I would suggest you have exposure to both asset classes. If you don't have much upfront capital to begin with, you can start by investing in stocks. The safest are, of course, index funds such as the S&P 500 or the FTSE 100. As your wealth grows, then you can start house hunting for buy-to-let property investments. To get started investing today, be sure to check out the revolutionary free trading apps such as Free Trade and Trading 212. I did a video comparing and contrasting these, and if you use the link below, you'll get a free share worth up to £100 when you sign up. Which investment do you think is better, stocks or property? I would love to know your thoughts, so drop that in the comments below. And if you enjoyed this video, go ahead, destroy that like button and definitely subscribe. See you next time.